The inflation shock that ended easy money. For more than a decade, money was unusually cheap. Interest rates stayed near historic lows, central banks bought trillions of dollars in securities, and investors learned to expect help whenever markets broke. Then inflation returned, and the system built for falling rates collided with the fastest tightening cycle in a generation. The final chapter began in 2020. The pandemic shut businesses, disrupted supply chains, and sent unemployment soaring. Governments replaced lost income with emergency spending. Central banks cut rates, purchased assets, and created lending programs designed to prevent a depression. The response worked faster than many expected. Household balance sheets were supported, credit markets reopened, and demand recovered. But the supply side of the economy could not move as quickly. Factories closed, shipping capacity tightened, semiconductor shortages spread, and workers changed jobs or left the labor force. More money was chasing a limited supply of goods. Used cars, furniture, energy, food, and housing became more expensive. At first, policymakers described much of the inflation as transitory. That judgment was not irrational. Some price spikes clearly came from reopening bottlenecks. But inflation broadened and lasted longer than expected. Housing costs rose, wages accelerated, services inflation strengthened. Russia's invasion of Ukraine added pressure to energy and food markets. By June 2022, the United States Consumer Price Index was 9.1% higher than a year earlier, the largest 12-month increase since 1981. The Federal Reserve's priorities changed abruptly. Supporting employment was no longer enough. Restoring price stability became essential because persistent inflation damages purchasing power and can become embedded in wages, contracts, and public expectations. The Fed ended asset purchases and raised the federal funds target range from near zero in early 2022 to above 5% by mid-2023. It also began reducing the securities held on its balance sheet. Other central banks tightened policy as well. Higher rates work by slowing demand. Mortgages become more expensive. Companies face higher borrowing costs. Consumers pay more for credit. Asset valuations fall because future cash flows are discounted at a higher rate. The process is deliberately uncomfortable. The economy must cool enough for price pressures to ease. The first major casualty was the bond market. Bonds issued when rates were low lost value as new bonds offered higher yields. That mattered far beyond professional traders. Banks, pension funds, insurers, mutual funds, and households all held assets priced for the old world. In Britain, leveraged pension strategies faced margin calls when government bond yields jumped in 2022. Forced selling threatened a self-reinforcing collapse, and the Bank of England intervened temporarily even while fighting inflation. In the United States, Silicon Valley Bank failed in March 2023 after depositors withdrew money and losses on long-duration securities undermined confidence. The bank had specific weaknesses, including concentrated uninsured deposits and poor interest rate risk management. Yet, the speed of rate increases exposed the vulnerability. Commercial real estate came under pressure as remote work reduced office demand and refinancing costs climbed. Private equity deals slowed. Venture funding became scarcer. Unprofitable companies that had survived on inexpensive capital were forced to cut costs, raise money on harsher terms, or close. The easy money era had rewarded duration, assets promising profits far in the future. Tight money rewarded cash flow in the present. Technology shares fell sharply before recovering unevenly. Cryptocurrencies and speculative vehicles experienced deep losses. Housing affordability deteriorated as prices remained elevated while mortgage rates jumped. Yet the predicted recession did not arrive immediately. Employment stayed resilient, consumers kept spending, and inflation gradually declined from its peak. The economy demonstrated that monetary policy acts with uncertain delays. Tightening can slow one sector quickly while taking much longer to affect another. This complicated the market narrative. Investors repeatedly anticipated rate cuts, sometimes pushing asset prices higher and loosening financial conditions before policymakers were ready. The old instinct to expect rescue did not disappear. It collided with the Fed's need to prevent inflation from returning. The era of easy money did not end on a single date. Its habits, debts, and valuations remain embedded in the system. Governments must refinance at higher yields. Businesses face a larger cost of capital. Homeowners with low fixed-rate mortgages are protected, while new buyers face a much harsher market. Banks and funds still hold securities created in the low-rate years. There are 4 lasting lessons. First, emergency policies can prevent catastrophe, but keeping them in place changes incentives. Second, low rates can move risk rather than eliminate it. Third, inflation limits the central bank's freedom to rescue markets. And fourth, the transition from cheap money can reveal losses that were hidden while asset prices kept rising. The age of easy money changed who borrowed, what investors bought, how companies were valued, and what markets expected from governments. Its end changed those rules again. The greatest legacy may be a contradiction. Modern economies now depend on deep financial markets, but those markets became accustomed to extraordinary support. Policymakers must contain crises without teaching investors that every risk will be rescued. They must control inflation without breaking institutions designed for lower rates. Cheap money made the future feel closer and risk feel smaller. Inflation reversed the illusion. Time had a price again. Debt had a cost again, and losses that seemed impossible became visible. The age of easy money was over. The bill had only begun to arrive.